Hey friends, Lucian here with the Bullish Bears team. This video is going to be about how to read penny stock charts. So let's go over some of the highlights and then I'm going to show you some real world examples. So what you want to look for when you're, doing penny stocks, you want to search in the morning during the pre-market for pre-market runners. So you're looking for stocks that have volume. And ideally, you want to see if they have news, a news catalyst with it. So again, use a tool, something like Trade Ideas. That's our favorite tool. But a good pre-market scanner that shows which stocks are running in the pre-market. And then use a tool such as Benzinga to check and see if it has any pre-market or actually any news that's happening in the pre-market, right? So that news catalyst along with volume is they're both really good catalysts to help a stock to potentially run when the market opens. So then what you want to do when you find a few of the stocks that are running in the pre-market, again, not all of them are going to have news. Many a times they'll just run for no rhyme or reason. But when you filter down your watch list, you want to map out the pre-market highs and lows and any other important support and resistance levels on the chart. And then you want to see, is the chart, in the pre-market, is the volume, is the price action in the pre-market, is it breaking, daily? Is it breaking a daily major, support or resistance level? So is the chart breaking out on the daily chart or a weekly or monthly chart? So major chart breakouts are really key. Then you also want to pay attention to major, pattern formations, things such as like bull flags, bear flags, ascending triangles, cup and handles. And then, when you kind of filter down your watch lists, then when the market opens and you see these, stocks running, you want to you have one of two scenarios, right? You can get in anticipation of a break. Obviously, you don't want to trade blindly. You have to understand patterns, but there's kind of one or two scenarios. You get in anticipation of a major break of a pattern, or you let the breakout happen, wait for the retest to hold, then look for your entry, right? So it's confirming the breakout. And other things to look for are reversals. So after you're in a position, look for reversal candlesticks and also trend line breaks for exits. So I'm going to show you some real world examples. These are just kind of some of the highlights of what to look for. But let's take a look at some real charts. So to start off, this is Trade Ideas. This is their morning gappers. So this is what you want to look for. If you're not using Trade Ideas, look for, use a pre-market scanner, whoever you're using. You want to look for stocks that have pre-market volume. So you can ignore most of these columns right now. Just go over to that column that's about, 7 over from the left that says volume today, and look at the volume. Ideally, there's not an exact science to how much a volume in the pre-market, because sometimes, the ones that have a ton of pre-market volume will dump at open, and other times the ones that don't have as much will end up ripping, right? So there's not an exact science, but when you look at those ones that have a lot of volume, 100,000 or more, and then when you see over 1 million, that's where traders are really paying attention to that particular stock. So you'll see in this scenario, there's a few that have over 1 million in volume. We're going to pay attention in these charts to LLIT and then also DSS. So let's take a look at a daily chart of LLIT. So as you can see, that big orange candlestick, that is having a major daily breakout. So this was a sub $1 stock that's gapping up, and we'll drill into the charts further, but you'll see it's breaking that yearly high just below $4, where that dotted red line is. So that is a major deal. It's having a major chart breakdown or breakout, and that's causing traders to pay attention. When stocks do this and they get lots of volume and they have major chart breakouts, it hits the scanners, and this is what lures in the day traders. So what you'll see on this chart here with LLIT is the gray shaded area and then the white area. The gray shaded area is pre-market and the white is market open. So you'll see I've mapped out some support and resistance levels, those lines going across in the pre-market. I mapped out pre-market highs and pre-market lows. Now that 842 level pre-market high is more than basically double the yearly high. So that is going to form, if that price at open broaches that level, that's a brand new yearly high. So it's a very important resistance level. And then you can see those support levels right around $4. So you'll see it kind of has that sideways channel. And then I do, again, angular and horizontal support and resistance levels. So you'll see, this is where we like to teach. We have our Candlesticks courses. We also have our ebook. We highly suggest downloading our Candlesticks ebook to learn about candlesticks. Again, they take time to learn, but they're the most essential aspect to any type of trading. They're the most reliable form of technical analysis. They're not foolproof by any means, but they're the most reliable when you're trading, because that gives you real world price action. See, when you're getting in and out of a trade, or anybody's getting in and out of the trade, that you can't hide that from a stock chart, right? So the buying and selling combination forms candlesticks, which form patterns, and those patterns form our charts. So they can't be hidden. They're not foolproof, again, by any means, but they're the best way to be able to manage your risk on areas to basically take or enter into and exit a position. So when I'm talking about candlestick patterns, you'll hear me saying a lot of times, don't get too bogged down, right? Because a lot of times you can think, you could say, is that a flag, or is it a wedge, or is it a pennant? Many a times patterns are telling the same story. It doesn't have to be a perfect flag or a perfect pennant pattern. Sometimes it could be off a little bit. It's telling you a story to pay attention to. But the reason why I'm saying this is, a lot of times you have to be careful, because if you don't know trend lines and support and resistance levels, you can see a pattern like this and you can say, oh, that's a falling wedge, or oh, that's a flag, it's going to break out, right? But then if you're not careful, it could be also a descending triangle. And this is where our emotional bias can come in a lot of times. And that's where you have to be careful is, we can see things that might not potentially be on a stock chart. So we could potentially, let's say, be bullish on a stock like this, and then it can end up just completely dumping and turning into a descending triangle and failing, right? So that's why it's important to look at the big overall support and resistance levels and the bigger picture overall. So this picture again right here, I'm going to kind of give you an angle to show you that, oh, that could be a falling wedge, a down channel, a potential flag, or it could also be a descending triangle. And you'll see that orange candlestick at the end is right at that important support level of $4. So whole and half dollar amounts are incredibly important support and resistance levels. So if a price breaks or goes near a resistance level that's a whole and half dollar amount, you want to see it break and hold and continue up. If price falls to a support level, you want to see it hold, and that's if you're bullish on a stock. Obviously, if you're bearish on a stock and you're going short, you're trading short, you want to see it fail at whole and half dollar amounts. So again, you'll see I mapped out, pre-market support and resistance levels. It created trend lines. I'm looking at the pattern overall, and you'll see price here is holding near pre-market support levels, just around that $4 level. So let's zoom in here a little bit on a chart, and you'll see here where price, I want to zoom in on that shooting star candlestick, that highlighted yellow candlestick. You'll see right here, my charts, again, everybody has different technical indicators. We're huge proponents of them, but we also don't want you to have analysis paralysis. So on my charts right there, you'll see the blue line is the 9 EMA. The red line's the 20 EMA, and then the pink line is the 50 SMA, black line is 200 SMA, and that turquoise color is the 100 SMA. So you'll see there's a 5-minute chart, price moving up, and it created a shooting star reversal off the 20 EMA red line, and those green dots is VWAP. So it kind of has a bear flag, kind of shooting star. It's rejecting, it's hitting that resistance level, and it ended up failing, and it's moving back down to that pre-market support level. So again, you want to pay attention to these reversals because again, if price can't break above resistance, that means it's hitting a ceiling and it's showing that it might want to potentially reverse, and now it's going right back down to support levels. So here's a summary of what I was just saying a moment ago with these technical indicators on here. So that pink line is the 50 SMA, or simple moving average line. The red is the 20 EMA, or exponential moving average line. The blue line is the 9 EMA. So if you have the 9 and the 20 on your charts, you don't need the 13 EMA. The 13 is the in-between of the 9 and the 20. There are a lot of traders that use the 13, so you could use the 13 EMA or the 9 and the 20, whatever you like better. The turquoise line is the 100 SMA. The black line is the 200 SMA. The green dots are VWAP, and the orange dots are previous close. Again, moving average lines, they're meant to be used as a guide. Don't use them, don't get analysis paralysis. But when you're trading, doing day trading, they're very important levels. Traders pay attention to them. They're very, very important support and resistance levels. So as long as you don't bog yourself down and give them too much weight, they're very helpful when trading. So let's drill down into LLIT, and you'll see there's a bear flag right here, right down to pre-market support levels. So you'll see kind of a bear, there's a lot of different patterns that are very important, but, bull flags, bear flags, very popular pattern. So you can see price right there, right at the open, it's falling right at the open, and then it's gravitating back to those moving average lines, right? So when price gets overbought and oversold, it tends to act like a rubber band and wants to gravitate back to those support and resistance levels. So you can see there price is falling, moving back to the resistance near those moving average lines, and then it ended up falling, and you can see it's bouncing off pre-market support levels right above that $4 level, right? So support and resistance, very, very important. When you see these patterns forming, and it's, they're bouncing off support and resistance levels, as well as those moving average lines, which are also support and resistance levels, they're very important to pay attention to. But right here, just wanted to show you an example of what a bear flag looks like. It's falling, went back up to those resistance levels of moving average lines, and then ended up falling back down to support. All right, now let's take a look at DSS, which was on the trade ideas I showed you earlier. So I mapped out again some pre-market support and resistance levels. I didn't mark out all of them, just some of the highlights. You'll see pre-market highs. I didn't map out all the lows, but you can see kind of the lows are near the bottom of the cup pattern that you can see there. So I want to just kind of draw your attention to cup and handles, another very popular pattern where you'll see kind of a cup pattern, or like kind of a rounded base forming. So you'll see that happen a lot. You'll see that especially with a lot of these penny stocks, they'll create those pre-market highs, and then at open they just kind of just don't do anything, or they just fall and they kind of do nothing for a while, and then they start to kind of do a rounded base and start to creep up before they tend to broach those pre-market highs and potentially break them. Doesn't always happen, but cup and handles are very popular patterns. So you're going to see right here what happens on this chart. I'm going to show you how this kind of evolves, but you can see that rounded base, which turns into kind of like a flag, right? So it kind of moves up. So rounded base moves up and then kind of consolidates right back down. No coincidence, right near that whole dollar amount of $6, right? So those whole and half dollar amounts, extremely important support and resistance level. So we're going to look at a few different areas on this chart, but I want to zoom right there on that bull flag, right? So bull flags, very popular, especially if you're bullish. If you're trading gappers and you're going long, that's probably the most popular pattern to pay attention to is the bull flag. Also ascending triangles, but bull flags are very, very important because they go up, they consolidate back, as you can see, right near those moving average lines a lot of times. And then on that bull flag, you'd get in at the break of that, depending on where you got in, at the break either above that orange hammer or above that small little blue one if you missed the orange one. So as the break out of that flag, you would get in at the break of it and then put a close below that, kind of the base of that flag as your stop. And then as you can see, price starts to rip and it moves up. Now again, when you see candlesticks like this, there's not really a science of when to exit. It's when it's again all your risk it's your risk management. Many times, especially with low floaters and penny stocks, get it in your head, you're going to sell too soon many of times, right? Yeah, you want to hit the home runs, of course, but a lot of these stocks, they have no rhyme or reason. You might sell too soon and the stock will go up and continue to rip, or you might stay in too long and then the thing just completely dumps on you. So that's where risk management is very important. So you can see here as the stock's breaking out, as it's extended, you can see price is kind of far away from those moving average lines. As you can see those wicks up top there, those are warning signs to sell that price can't break above resistance, and that's happening, no coincidence, right around a whole dollar amount of $7. So if you didn't sell in that area, when you see price start to fail that 708 level and create that shooting star, that's your warning of, hey, get out, right? You could stay in, but look what happened. If you didn't get out there, you're going right back to where your entry was and you gave up all your profits. So if you got in around that $6 level, you could have sold on a trade like that right around $7. That's $1 per share, right? Or $1 profit times however many shares you got. If you had 1,000 shares of that, that would have been $1,000 trade. That's a great trade. So let's drill down into here a little bit more, and you'll see that top line is pre-market high. And as I was just saying, that shooting star failure, it's happening right near that pre-market high. So you can see those candlesticks, right? There's a few of them, 1, 2, 3 of them. And then that was the fourth one that couldn't hold that 683 pre-market high. And then it failed right below that $7 level. So that's a warning to get out. Again, the stock can pull back and then continue to rip and go up. It's just your warning sign to potentially get out. Then you can look at those volume bars below, so pay attention to those big volume bar spikes. I didn't highlight it, but the one where the shooting star is, I should have highlighted that one. That is a big selling volume bar as well. So that's the biggest bar out of all of them. So pay attention to those volume bar spikes. Very, very important. So you'll see price hit resistance or that ceiling, and then it failed. So that happens a lot of times with those shooting stars or dojis or spinning top reversals. Now let's drill down again a little bit more. You can see again pre-market high. I re-put in that flag again where the breakout was. So this is where, again, you have to determine your risk management and when you want to sell and take profits and how long you want to decide holding. But as that bull flag broke out, you had that 2 minutes of those bullish candles, and then you had that kind of that smaller, orange spinning top kind of candlestick right below pre-market highs. That's where you could decide to take your profits there, right? You could sell some of your position, all of your position, watch for a pullback to hold of support. Remember, hindsight's 20/20, right? You can see these candles right now, but if you ignore all those other ones and just look at that one where it's showing profit taking, you don't know the other ones after that are going to happen. So if you decided to take your profits there and you got an entry right around $6 and you sold around that 660 level, that's a phenomenal trade. You'll take that all day long. That's about a 60-cent trade. So that ain't bad, taking that profits right there. Now, again, what happened was you could have sold too early there. You can see that hammer held right over that 9 EMA. It ripped up, and then it moved up to pre-market highs, and you can see 1, 2, and then a third candlestick happened. So you could have gotten more, maybe another 20 cents. It actually went up to $7. You could have waited as price went up and rejected off $7 and made more money, right? So but again, hindsight's 20/20. So you could have sold, made 60 cents. Yes, you could have held longer and made another 40 cents more, but that stock could also dump right back down just as easily, right? So this is where it's important to pay attention to, level 2, see where the buyers and sellers are. But when price is broaching that whole dollar amount of $7, and you'll see a lot of those walls of sellers coming in, and you have to be very careful there. So as you can see, price rejects that $7 and it ends up failing. So once it's failing that pre-market highs, at that 680s level, that's another warning sign to potentially sell as well. So if you didn't take your profits before, now you're right back down again to that previous level of that 660s to sell. Now, if you don't sell there and you're staying in, you can use that 9 EMA as a guide, or the 13 EMA for short-term momentum. So if you want to see if it's going to hold, you could still technically stay in the position. You got to be more careful. If it's a lower float stock, you have to be careful because, again, it can really dump on you. If it's a higher float stock, you might have a better chance to stay in a little bit longer. But what you'll see is, again, it's hitting that ceiling, so it's showing you that it's having a tough time moving up. So you'll see there's the bull flag breakout. You get in above that small little blue candlestick as it's breaking out of that flag, using a candle close below that as your stop. And then as it's starting to hit the ceiling and you see those reversal candles, that's when you consider taking your profits. But I can't stress it enough. You buy low, sell high. The problem is most new traders, they follow a guru or a chat room service or a pumping service, which we are not. We do not pump and dump to our community members. We teach how to trade. We don't tell you what to trade, especially with these low floaters and these penny stocks. And the problem is a lot of the new traders, they miss that bull flag entry, that smaller pullback, and they end up buying near these levels, the tops. So they're buying high and then the stock falls. Where the guru is buying low, they're pumping it up, and their followers or other people are following it, and they're buying the tops of these candlesticks, which are at resistance levels. You want to buy low near support levels and sell high. Don't be these traders that are coming in near these resistance levels, buying at $6.80 and $7 at resistance levels. That's where you're buying high, and then you end up selling low and losing money. That's something you do not want to do. Now I want to show you the head and shoulders pattern. So picture exactly like I'm saying, a head and two shoulders. Now typically the head is the center, it's the peak level, and then you have a left shoulder and right shoulder. Typically the left shoulder is higher than the right shoulder or equal to. Sometimes you'll get a fake out where the right shoulder might break above the left shoulder. That could be a fake out, but it's showing a previous peak level. Then the head, that would be the left shoulder, and then the center or the head goes in and breaks above that left shoulder, creating a new high. Price falls, and then it kind of jumps back up again, and it doesn't break the left shoulder. Now you have a right shoulder, and head and shoulders patterns are typically reversal patterns to the downside. These happen all the time in all different time frames, and they happen a lot with penny stocks. So be aware of these. That head and shoulders pattern, very, very, very important pattern to be aware of. And you'll see this happens right at support and resistance levels. So you'll see it's rejecting right at that pre-market high. So you have 1, 2, 3 attempts, and it's not holding pre-market highs. And what is it doing? It's falling back down towards support levels. So if you held through all that and didn't take your profits on that bull flag breakout, now you're heading back down towards your entry point. So that's where greed comes in. If you hold too long, you can give back all your profits. And then if you're like, oh, it's going to go back up again, that's where price can end up failing below the $6, and now you lose money. So you could have been up almost $1,000. Then if you're not careful, you can end up being down a lot further. So this is why looking at candlesticks and reversal patterns near resistance levels is important when looking to exit a trade. So as you can see here, price as it starts to evolve, you have that kind of that down channel, and then you can see price kind of goes on that down channel, and it kind of breaks out a little bit above that 650 level. But what did it do? It comes back right back down and ends up failing. No coincidence, right around a $0.50 amount. So it's kind of breaking out of that channel, coming back down and retesting that channel right at a $0.50 amount. Lots of this price action happens right around whole and $0.50 amount. So that's a false breakout. That's where traders could get trapped there. But as it continues to evolve, you can see higher lows are starting to form. So you can see I did an angular support, that blue kind of lighter shaded support line. You'll see price is now continuing up, and this is where trend lines are important. You can see higher lows are forming, and it's happening again right near that 650 level. And you can see there's several candlesticks, 5 or 6 there, that are holding above that 650 level, but they are still showing some weakness, and you can see they're rejecting above, right below that $7, you know, what is a little darker shaded red there. So you can see now it could be forming another potential head and shoulders. So, you know, this could be tricking the buyers to come back in, and they could be scalping in between. You know, those are scalps, 650 up to 670. There's traders that are scalping 10 cents in there, you know. The new traders coming in thinking, oh, let me buy it 650 and it's going to go back up to the moon up to $7. Well, not necessarily. There's those day traders, they're buying 10,000 shares trying to scalp 5 and 10 cents in those small little moves. But as you can see, watch there, you can see angular support is kind of holding that 650 level, would be a very, very important support level. So as it shook out a little bit before in the previous slide, now there's kind of some support holding continuing up, but it's still showing some weakness. And as you can see here, angular support, I now made it darker and ended up failing. So the bears got control, price fell, it failed that 650 level, and now I recreated and created a newer angular resistance level. So finding those channels, very, very important. So now price is hitting those ceiling levels, those lower highs are now forming. So you have that kind of the ceiling, it fell and broke angular support, and now it's got a lot of angular resistance. So I didn't extend the trend lines on this chart, but my trend lines extend to the future. So these support and resistance levels, what happens in the past is very important and it affects the future. So if price can't break those angular resistance levels, then you look for angular support, and then those other areas below, VWAP, you can see the 100 SMA, the 200 SMA. If it can't break that ceiling level, it could end up failing down to those floor levels. And now let's just take a zoom out on the chart of DSS, and voila, look at that. You can see this is all happening on a daily chart breakout, and price is caught in between the moving average lines. And as you can see, it's rejecting right off that 200 SMA on the daily. Very, very important support and resistance level, that 200 SMA is very, very big deal. And you can see all this is happening right between those moving average lines. And you can see that huge volume spike. So it's gapping up, lots of volume. All the traders, you know, lots of day traders are paying attention. Price rejected at that whole dollar amount right near that 200 SMA. So again, moving average lines are not foolproof by any means, but they're very popular, especially amongst day traders for those very important support and resistance levels. So again, our day trading community, or our trading community in general, is a great place to learn trading. We have several different trade rooms. We teach all different trading styles. We teach penny stocks, day trading, swing trading, options, futures, all that good stuff. But if you want to learn how to trade, come and join us. We teach each day in our trade room. It's a great place to interact with other traders, you know, ask the mods questions. We teach this stuff live. Again, we are not a pump and dump community. We are not pumping penny stocks to our members. We're showing the goods and the bads of penny stocks. We're showing where you would potentially buy and where you would potentially sell, but we're not telling you which ones to buy. We're not pumping these stocks to our members. We're teaching you how to do it yourself. So it's a great place to interact and learn, especially if you're new. Open a paper trading account, you know, follow our watch list and our trade alert setups that we do each night. Practice implementing them into your own brokerage account, right? But practice with a paper account if you're brand new. Track your trades, look for a 60 to 70% win-loss ratio. So make sure your winners outweigh your losers. That's how you track them. Have at least a 1 to 3 or 4 risk reward ratio. At minimum 1 to 2. So if you're risking 10 cents on a stop on a trade, you want the ability to make at least 20 to 40 cents. And that's how your winners will outweigh your losses. So again, you practice paper trading, making a couple hundred, you know, successful trades. And once you start to nail it down, then you slowly scale your way up with real money. So hopefully this video helped you, and we will see you in our community. Enjoy.